Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand, evidence-based, holistic insights to help you master the game of building wealth. Just a reminder, I talk about at the end of today's episode, talk about my new book, Wealth by Design. Just a quick plug for that one. Okay, you're going to get bored of me talking about that book, by the way, over the next few months. I'll try not to do it every episode. Okay, let's get into today's Q&A episode. Really interesting one to begin with from Sam. And actually just looking at the email trail, it looks like Sam emailed the question in June 25. And unfortunately, my apologies, had to follow it up in January. So anyway, I'm looking at it now, Sam. So apologies for missing it. Okay, so a bit of a rundown of Sam's situation. He's 52. His wife is 42. His home in Sydney's worth 2.6 with 1.1 mil of debt. So reasonably large home loan at age 52. Shares 700. Super is 600. I imagine that's combined. Oh no, that's just his actually. Wife's super is 60. So 660 of super. He earns 300 to 400 grand. Wife earns 70,000 working part time. 2 kids in private schools, costing about 60 grand a year. That has about 3.5 years left to go in terms of them finishing private school, of course. And the big question that Sam's grappling with is, should he go and buy an investment property? In terms of goals, he would like to stop full-time work in 7 to 9 years, so the next 7 to 9 years. Although, his wife's 10 years younger than him, so, that sort of 59 to 61 for Sam, but his wife's 10 years younger, so she'll probably keep working part-time, and he might do some part-time work as well. That's kind of important for me to know, like whether there's any desire or capacity to continue to earn in that kind of first phase of retirement, if you like, because it's important. I'll come back to it. Sam's made a couple of property decisions. He admits he's made a couple of property mistakes, I should say. In '02, he purchased an apartment off the plan in a regional location, sold it for 280, sold it 18 years later for 330, and then frustratingly, 2 years later, it doubled because of the COVID impact. And as a result of making that mistake and eating some of his borrowing capacity, when he bought his home in Sydney in '07, he couldn't borrow as much as he would have otherwise. And so the growth gap there is almost short of $1 million. And he's been contemplating whether to buy an investment property for the last 5 years. Meanwhile, he's seen lots of properties go through the roof in Noosa, in Perth, and so forth. So, I mention it not to rub salt in the wounds. I mean, Sam was the one that kindly admitted to those mistakes. But I mention it because I wrote a blog back in February 21, and the title of that blog was Good Financial Decisions Compound. Don't have an episode number for you because I wasn't numbering the episodes at that time, which is a pretty dumb move. But that's kind of the point of that blog, was that, I reckon there's probably a handful of decisions people make in their lifetime. In fact, a different way to frame that is to say that the top 5 financial decisions, the 5 most important financial decisions that anyone makes in their lifetime, will probably determine more than 80% of their financial outcomes. And so there's these relatively few number of financial decisions that if you get right, it dramatically changes your outcome. And that's what Sam's saying in his circumstance. So it's kind of real life example to that thesis, or that observation, really. It's an observation I've made over the last 20 odd years. So, and it's bang on. And he's at this point now. So to my mind, Sam is at this point now. What decision he makes circa 10 years away from wanting to retire, the quality of that decision will probably mean a huge difference to him in terms of retirement, but also, deeper into retirement. So that decision will compound. So Sam mentions they've got a good family income. As I said, he earns 300 to 400, wife earns 70. So let's call it 400 to 500 family income. But he admits there's been a little bit of lifestyle inflation there as their incomes have risen, but they feel like they can afford investment property. So if the out-of-pocket costs were sort of $2,500, $3,000 a month, they could afford to do that, although acknowledging that's going to come at the sacrifice of spending that money on, improving their standard of living, but it is affordable. The things that I think about in someone like Sam's situation, the big one that stands out is the $1.1 million of debt. and we've only got 10 years, less than 10 years, let's call it 9, to repay it. So, that's around about $125,000 a year we've got to find on an after-tax basis to contribute towards the loan. That's not even counting the interest. So that one stands out to me as an issue because it means either we're going to have to really tighten the belt and aggressively focus on home loan debt reduction over the next 9 years, or alternatively, we need to think of something else. When I look at super, we've got 660 of super, all going well. That should certainly double over the next decade. So that's going to give us 1.3 mil of super. It's probably not enough. And certainly there'll be some lifestyle compromises that need to be made. So, it's not like we've got the luxury of just focusing on debt reduction, repaying the home loan, knowing that we've got other assets that are already compounding. That's not the case. So, in Sam's situation, to me, it starts to feel like, yeah, you should buy a property, and you probably should have bought a property, Sam, 5 years ago when you were contemplating it. But you've got to be very careful here too, because it's got to be a good property. You don't have any room for making a mistake, and you've got to nail that asset selection. So I wouldn't be buying in Queensland because, the risk is that there's too great a risk that you're too deep into that growth cycle. It's in its 8th year of its growth cycle. Now, it could persist for another 12 years, so the growth cycle could be 20, of course. No one really knows, but probability is much lower. So I think it's a Melbourne purchase, but you talk about, a potential borrowing capacity of about 1.1 in order to, buy the asset. I think you might need a little bit more than that. I think if you're going to do this, do it well, which means buy an asset that is the highest quality asset you can afford, because ultimately that reduces your risk. Now, the way that I'd look at this, primarily, the number one reason why I want to buy this property is for a debt reduction strategy. So, of course, I look at Sam's situation and say to myself, well, and particularly when school fees disappear, it's entirely possible that he can repay on average $125,000 of principal. So it's possible that over the next 9 years, they'll have enough surplus cash flow to do that. But what I want is a really good plan B. And it's too tight. Like, the chance of a change in circumstances or him not having as much cash flow as he might expect it's relatively high. It's certainly possible and plausible. That could be the outcome. So therefore, in those sorts of situations, I definitely want a plan B. So that would be my primary attraction to investing in property. Is I want to do it because I want to make sure by the time I get to 60 odd, that I don't have to keep working because I have a home loan, that I can then go out and get a part-time job if I want to, or do some other type of work that might not necessarily pay as well, but also isn't as stressful and time-consuming. And then as long as that's enough to cover my living expenses, I don't need to draw on super, and I can let super compound for another period of time. In fact, I can do that until my wife's 60, so another 10 years. And so it'll go from 660 to, let's call it 1.3 to 2.6. And that will be time heals all wounds, really, in a way. So that would be enough to get me there. So that's the main reason why I buy an investment property. Of course, the second reason is that what happens if super doesn't perform. And it's not like, 1.3, if you get to 60, you've got 1.3 in total in super. Okay, your wife might continue to work for a period of time, so you don't need to draw a huge amount from super. Well, you can't, but you can only draw from your account. But, it's kind of line ball, if you like. So you want to make sure that you've got more than enough wealth to achieve your goals, not almost just enough. And so that would be the secondary reason to buy an investment property. I should say that Sam did mention, his email is quite long, so I paraphrased a lot of it, but I did mention, should have mentioned that Sam also said, look, he's probably going to get an inheritance and his wife will probably get an inheritance. So he expects to receive 1.2 to 1.4 million in today's dollars and wife around $2 million, but they obviously don't want to rely on it. Well, one of the things with buying an investment property like this, you can go, well, at least there's a potential debt exit strategy there down the track. If you do get inheritance, you don't rely on it. But if you do get inheritance, well, that's one way that, if I get the inheritance, I can put it in the offset account against any investment loans. And, then I've got another source of retirement income. So again, not planning around it, but at least you'll understand how that inheritance would accommodate that strategy. Now, the final comment I'd like to make, and I would say this to anyone in similar situation, is it's great to go and buy a property today expecting that it's going to generate a lot of capital growth over the next 10 years. In fact, that's kind of the attraction and that's the main game, of course. but it might not happen. And so you've got to make friends with worst case scenario, maybe not absolute worst case scenario, but worst material, your sort of negative case scenario. So I think if I'm going to buy, if I was speaking to Sam, and of course I am sort of indirectly, but if I'm speaking to Sam, I'd say, look, let's go and buy the investment property. Let's maximize the budget as much as we can, as much as we're comfortable, so we can get a really good quality property. Let's use a really good buyer's agent because we don't have the time up our sleeve to compensate for making a mistake. We need to nail this decision. And then finally, let's make friends with not selling the property in 10 years' time. Let's make friends with a situation where you might get to age 60 and you're not ready to sell, either because the market, the returns haven't been as good as we expect, the market's not right, whatever it might be. And let's try and keep this property for at least 15 plus years. And in that situation, you might be forced, as a result of making this decision today, you've got to make friends with the potential outcome that you might be forced to continue to work beyond 60. Maybe not in your capacity, in your current capacity, in your current role, but at least some sort of work. So what I'm saying here is go out and buy an investment property. It means that you're going to obviously take out a pretty substantial loan. That's a substantial commitment. And you've got to make friends with that commitment actually gets you further away from retirement, not closer to it in a way, because you've got this ongoing interest that you need to pay for. And just make friends with, what happens if you're 60 and you've got to then go out and find a job and go and earn 70 grand a year or something like that. Are you okay with that? And that's how I put it to Sam. And if he could make friends with that potential outcome, then I think going out and buying an investment property is the best thing for him to do. So anyway, I just wanted to talk through that. I mean, there's a lot of talking from me, but I just wanted to sort of talk through from that, and hopefully, Sam, that helps answer your question. And apologies for missing it initially back in June last year. Okay, next question is from Daniel. My name's Daniel. We're a couple in Adelaide, middle to low income earners. He earns 105,000 plus 18% super, so obviously works for university or public sector. Anyway, wife earns 70,000 with 12% super contributions, so they're just the normal. He's 48, she's 51. Home worth 1.1 to 1.2. Loan, as I understand it, 280 with 200 in offset account or extra repayments, so really 80,000 of net home loan debt, which isn't a lot. Previously owned 2 investment properties, one they acquired in 2008, another one in 12, which they regrettably sold in 2019, so just before COVID, which they obviously regret, but it was off the back of building their primary place of residence, their current home. And really, Daniel's trying to work out what next in terms of what they need to do as an investment strategy so that they can retire at 58, so 10 years' time, or 60 at a stretch, earning 120,000 per annum. I was almost going to say they didn't tell me super balances. Actually, his super balance is 285,000 and hers is 180. So relatively low for their ages. So it's a really interesting decision. Really, they've got almost, just shy of 500,000 of net investment assets, and they want to retire in 10 years' time. And they're making pretty reasonable super contributions so that those assets will build. So let's say that $500,000 is going to be worth, say, $1 million. 1.2 or something like that in 10 years' time. So it's probably not going to be enough to fund their goals. Daniel asks, do we just, pay down the home, maximize super contributions and make additional investments outside super, or do we buy an investment property? Well, I wouldn't worry about the home loan too much. You're going to repay it 80 grand. It's not a huge amount. You've really got to buy more growth assets. That's really the answer here, because you want to build your investment assets. You don't really care about your home loan at this stage. It's not going to move the dial, right? If you really focus on it, big deal. It's not going to get closer to retirement or be in a stronger situation. I wouldn't invest outside super. If the plan is to work to 58, you're going to get pretty close to being accessing super then. I mean, you'll need a little bit outside super to fund potentially the first 2 years of retirement, but I wouldn't want to accumulate a huge amount of assets outside of super. So that's if you're just investing your cash flow. I guess you could, it's kind of similar situation to Sam where you've got a 10-year time horizon. And so I'd say all the same things to you as I said to Sam. If you're going to buy a property now, you want to not make a mistake. So you really want to nail the execution part in terms terms of buying the right asset. And then you've got to kind of make friends with the potential outcome. It might force you to work longer. So in your situation, you've got a lower income than Sam. So I would say it might force you to work in your current capacity for, maybe till 65. Because if it doesn't all work out perfectly, returns aren't perfectly straight line, you never know what's going to happen down the track. I think you're just better off to make friends with that potential worst case outcome, if you like, realistic worst case outcome, before you go into something like this, that rather than get surprised on the downside. But I think in your situation, if you want to meet that sort of $120,000 in terms of living expenses, and you've got that 10-year time frame, I think the only way you're going to get there is with some gearing. But my concern is whether you're going to have enough borrowing capacity to be able to do that. Look, you can probably borrow $1 million. Maybe you're buying then a villa unit. You're in Adelaide, so I wouldn't be buying in Adelaide right now because you'd be buying right at the end of the growth cycle. Maybe you buy yourself a good villa unit in a good blue chip suburb in Melbourne. That would work. That would be the best type of asset, I think, at a price point that you could afford in a market that I think offered the best returns over the next 10 years. But if you weren't prepared to do that, as in invest outside your domicile state, if you weren't prepared to borrow that sort of money, then I would take it off the table. So there's no point doing it by halves. There's no point saying, well, I'm going to go and buy in a regional town for 600,000. Not after the regions have done so well relative to the capital cities. That mean reversion's just going to hurt you in the long run, I think. So you either do it really well and do that villa unit situation that I just spoke about, or you take it off the table and just focus on getting as much money into super as possible, building a couple of years of living expenses outside of super. Yes, repaying the mortgage, but don't really focus on it. It's growth assets. You want compounding returns that are going to get you there, and that's probably the best that you can do. And if that doesn't work, I guess downside is you've got to work to 65 instead of 60. But the gearing is probably going to help you, as long as, again, you make friends with, again, if the returns aren't what you expect or change in circumstances, you might have to go to 65 as well. So it's not a magic bullet. Of course, you can come up with a set of projections that could show you how you're going to get there, by investing in property, which is in fact what I'm going to talk about tomorrow. But I'd just be cautious. I'll always plan for the worst, hope for the best, if you like. Anyway, Daniel, thanks for your question, and very much appreciate it. Okay, next question is from Nick. Firstly, I'd like to thank you for, I don't need to read out the good feedback. Sorry about that. Okay, I've got an existing portfolio of 3 properties with a trusted team, buyer's agent, broker, and accountant, who I'm happy with just like an outside perspective. I seek your advice because listening to your scenarios, I've learned so much and feel your audience might also be in a similar situation and could benefit from your insights relating to some of my key real-life hurdles at this stage of investing. My wife and I, both emergency service workers and have been for some time, have a combined income of $133,000 after tax. We have 2 kids, aged 16 and 13, and looking to scale our portfolio to bring forward retirement. My wife is 53 and she'd like to retire in 4 years. I'm 48 and would like to retire in 7 years instead of 12, which is at 60. Current structure is the home with 1.2 with 240,000 of home loan. And then there's 2 investment properties, one in Perth and one in Ballarat, with about 1.15 of debt against them. And then there's a property in Geelong in a self-managed super fund, 530, with 280,000 of debt against that one. And then Nick talks about some projections, although I'm not really understanding it. I think he's projecting the properties to be worth 3.2 in 12 years' time or something like that. Hypothetically, he says, assuming historic growth, we can downsize the home and purchase a 1.6 million property with no debt, and we'd still have net 2.2 million generating income, not taking into account any tax strategies. But the above scenario requires them to work another 12 years, which they don't want to do. We've been passive to date, but understand that active investing might be required to bring forward retirement. The portfolio is just under $2,000 a month in terms of negative cash flow, and they're funding $1,200 from cash and the rest from equity buffers. So they're actually borrowing some of the negative cash flow cost of the properties. Anyway, they've extracted some equity from one of the properties. They're really just thinking about what to do next. So I think I understand Nick's scenario, and I hope I haven't lost you with some of that information. But okay, let me see if I can answer his question. The first thing is, which I'm going to talk about tomorrow, isn't it interesting that I answer a couple of questions that are really based off projections? And I'm going to talk about that tomorrow, so I probably don't need to worry about getting into that. But, just be careful about projections, extrapolating historic growth, all these sorts of things. It just depends on the quality and nature of the property, but looking at some of those values and locations, I'm not sure that I'd be ultra confident about assuming, a huge return on these assets. And one of the points I make tomorrow is like, well, if it's a really great asset, I would think the return's going to be 8 to 10% compounding over a very long period of time, including income and growth. If you're going to assume more than 8 to 10%, that's a red flag. And so, if you're getting a decent rental yield, and the property's not a great asset, like it's in Ballarat or Geelong, it's not in South Yarra or Paran or Toorak, then you've got to back off the assumption, right? You just can't expect the same returns. So total returns over a long period of time, you've got to assume you're going to be 1 or 2% lower than that 8 to 10%. That's the best way to model these things so that you're not going to wake up in 10 years' time and go, well, that didn't work and I wasted the 10 years. Ultimately, and it sort of comes back to what I was saying earlier, there's a bunch of different decisions you need to make, only a handful of different decisions you need to make in your lifetime. And for Nick, this is one of them. Do they, be a bit more active and go and buy some properties and flip them and renovate them and do those sorts of things? Or is the answer to Nick's question, instead of having, a property in Perth and a property in Ballarat, why not put it all into one property? I mean, that's what I would have done. He's got 1.2 of value locked up in those two properties. Why don't you put that 1.2, somewhere else, somewhere better, a better quality asset? Now, Perth is, I wouldn't upset Perth. Rising tidal ships rise. That one's going to do okay. The Ballarat one, maybe not so much. So if you're going to be an active investor or you want to try and extract more returns, that's where you probably want to do it. Like, think about what you can do to Ballarat in terms of improving its cash flow. So that's obviously improving the dwelling, and do that, because that will improve your situation. Also, just a warning for people. I mean, I don't like the strategy of borrowing some of the negative cash flow, because that strategy requires pretty consistent capital growth to occur. So that is, just to clarify, what Nick was saying is that the properties cost him $2,000 on average, where he's only putting in $1,200 of his own money. He's borrowing $800 a month to help with managing the negative cash flow. So for those, a lot of people listening to this podcast won't be old enough to remember, but before the GFC, so I'm really talking around 06, 07, 08, there was a really big groundswell at that time of living off equity, which meant that go and buy all this property, heaps of growth, and there was heaps of growth at the time, and then just go and borrow against the equity, and that's how you're going to fund your retirement. And, it didn't work out. It all blew up when the GFC occurred. And I don't mind it as a temporary strategy in terms of borrowing the negative cash flow, but I just don't like it as a strategy. It's a hallmark that you've overborrowed, or when you've made those borrowing decisions, you have then subsequently let a little bit of lifestyle inflation creep in and you're spending too much. So I don't know, have enough information of Nick's situation to make that judgment. It's just an observation, so I'm not having a go at you, Nick, but that's something I'm just not that keen on. At the end of the day, the quality of your assets will determine your outcomes. So, if Nick wants an early retirement, it's not about choosing a high quality strategy. It's really about choosing an evidence-based strategy, but underpinning it with quality assets. No matter how good the strategy is, it can't make up for subpar assets. And so I understand, Nick's way of thinking, what else can I do? But really the question's better put not only to solve this short-term challenge in terms of how can I retire sooner, but you don't want to be too short-term focused at the cost of your long-term results. So ultimately, the answer to both those questions is really about quality. Do the assets that underpin my strategy at this stage, do the quality of those assets, will they get me to where I need to be? And as I said, I think Perth is still going to continue to grow, but it's all about that quality. So you've got to then think about the Geelong property and the self-managed super fund. I've seen lots of situations, particularly where people have bought property in self-managed super funds and they haven't done that well, and they're not getting the negative gearing. And sure, they can save on capital gains tax if they move to pension phase, but if there's no capital gains, there's no tax to save. So I'd just be careful, really careful about the asset quality. And I don't think the answer is a different strategy. I think the answer is always look at the quality of assets. Okay, next question is from someone that wants to remain anonymous. Husband's 38, wife's 37, combined income 260, 180 plus 80,000. Home worth 1.2 with 700 owing. Just did a renovation on the home, so it's in Tasmania, but in a great location, apparently with good growth. They've got one kid in private school, 300,000 of combined super, and contributing around 15% of income, so making additional contributions into super. A small amount of ETFs and about 25 grand as a cash buffer in the offset account. And they're conservative. They don't like debt too much, don't want to take on too much debt. Probably can't afford an investment property just from a cash flow perspective and also from a comfort level. And so the listener would like to know what to do with their surplus cash flow. Should they just be putting as much money into the share market, for instance, as they can, and then look at purchasing investment property when their borrowing capacity improves, maybe when the children are a little bit older? So I didn't say 2 children, 2 and 5. Or should they repay the home loan, so forget about growth assets and just put it towards debt reduction? What is the long-term strategy for them? So 37, 38, but I think the ages are important, but the ages of the kids are even more important. I've said it many, many times, really difficult at that age to find surplus capacity because family income's lower, expenses are higher, childcare, all these sorts of things going on. It's a really challenging time, but ages 37, 38 means that you've got, 20 plus years in terms of a runway to build wealth. And you've also, putting it differently, you've also got 20 plus years to repay the home loan. And the other thing with the home loan repayment, I've written about this before, but many years ago, in terms of how important is it to repay the home, one of the considerations I think is the growth of the asset. Now, I'm not saying that Tasmania is always going to grow just as fast as Melbourne and Sydney and so forth. I mean, it more recently probably has, but, that's anomaly, I think. But really, if you're in a good location, so this listener said that they're in a great street, very sought after, has experienced strong growth. In that situation, the home loan starts to become less important. I'm not saying it's not important, but because the home loan will become quite immaterial relative to the asset value. Whereas if you've got a property in the middle of nowhere and expect no growth or very little growth, then you're always going to be relatively highly leveraged unless you make aggressive home loan repayments. So that's something I think about. Look, because you've got 20 plus years and you've got, good incomes, I don't think your home loan, repaying the home loan is such a priority. I think a combination of extra repayments as much as you can throughout this time and share investing makes sense. But the $25,000 in the offset account, which I'm going to just assume that's your total savings, I would prefer like 6 months of expenses just from a comfort perspective. So actually, if I was in your situation, I would probably build that buffer in the offset account. And particularly if you're kind of concerned about debt, I think having a really sound and safe buffer in place is a really good place to start. So look, I don't know what your annual expenses are, but maybe it's like saving 60 odd thousand in the offset account. So maybe another 35,000. And that might take you a little bit of time to actually get there. But then I think you're in a good position then to start balancing out debt reduction with building growth assets. And I think the strategy, if I was in your shoes, the strategy should be to buy an investment property in Melbourne, well, not in Tasmania, so somewhere else, investment grade property as soon as you can afford to do so and you feel comfortable doing so. Now, that day may never arrive, right? So you might not ever get into a situation where it just doesn't, the stars don't align and you're not ready to do so. But I would just try and, convince yourself mentally that if I'm ever in the situation that I'm ready to do it, I will do it, and kind of lock that in if you like. So don't procrastinate. When you get to that time, don't procrastinate. And the reason I say that is sometimes it's unforeseeable at this stage of life. But what could happen and what does happen in my experience, at least I don't necessarily have a perfectly representative sort of data set to work off because of course the people that come to us do have more surplus capacity, but it's more often than not what happens is people's incomes really do grow. They build their equity in their house more and more, so they feel like they're in a stronger financial position. Their super does well. And, 5 years from now, you might be actually in a completely completely different financial situation where you go, yeah, I'm quite happy to take on that debt and buy a property in Melbourne. So whilst that you can't necessarily map that out today, it's not perfectly foreseeable, and it does depend, distribution of returns and all these sorts of things. But I would just be of a mind to say, if we are ever in that situation, we're going to go and do it, but realizing that that situation may never come. Build the buffer in the offset account, then focus on building growth assets. You're already contributing probably enough into super, so I keep going, but probably don't focus on super too much more, because remember, you can't access it for 20 years, which is a positive and negative, and then start building those assets outside of super. So share market investments, of course. You might do some debt recycling in terms of, allow you to focus on repaying as much as you can against the home loan and then borrowing to invest in the share market. So that's always an option as well. As I said, until such time where you might wake up one day and go, yep, buying an investment property in Melbourne or wherever it might be is now within sight. So thank you very much for your question. I hope that sort of answers it for, people in your situation and yourself, of course. Okay, I'm going to leave it there. Tomorrow I'm going to talk about financial modeling, because I see it's becoming more commonplace in terms of businesses offering this. And, we just need to be careful with financial modeling. We do it too. And so, the same rules apply to us. But anyway, we'll talk about that tomorrow. And if you want to hear about my new book, just hang on a little bit longer. Otherwise, I'll see you tomorrow. Now, before you go, one last thing. My new book is called Wealth by Design. It's not a reprint of Investopoly. It's a complete and absolute rewrite based on what I've refined over the last 8 years. If you'd like to be notified the day pre-orders open and receive my pre-order bonus, register your email right now at investopoly.com.au/book. The bonus is a Investopoly research assistant. That's an AI tool that's trained on more than 500 of my blogs that I've written over the past decade. So you can ask it a question and it'll take you to the most relevant ideas and framework. And I'll keep feeding it all my future blogs too, so it'll become a tool you can use ongoing. Again, register at investopoly.com.au/book. Thanks for listening. I appreciate your time.